Hi everyone, I'm Colin, Portfolio Manager at iFAST Bond Research Team. So welcome again to FSM Expo 2024. So it is very good to see everyone back here again and to see some familiar faces in the crowd. So as my title suggests, the fixed income universe is undergoing a transformation. That is a big word. So with a higher interest rate as well as inflation potentially here to stay, we think we might be entering a period of higher short-term yields. So this is something scary for many investors, as this is something unfamiliar since the great financial crisis. So in this session, I'll be sharing why bonds remain important to your portfolio, and more importantly, amidst the current backdrop, the opportunities we see in 2024. So let's start off with a recap on the performance of major bond markets last year. So as you can see from the screens here, in short, 2023 was a year filled with hurdles for bond markets where inflation surprises and policy rate hikes acted as key headwinds for bond markets. As you can see, major bond markets rose in January, having a good start. However, US Treasury yields were very volatile in the first half of last year due to inflation data and how markets digested the Fed's result, and that caused yields to rise and fall wildly in that first half of the year. So this has kept bond market performance muted from February to July. But in the second half of the year, Treasury yields began to climb ferociously, especially from late July to November. As a result, performance for most bond markets weakened further. Fortunately for investors, this was short-lived, as you can see that yields began to fall in November, and after the Fed's dovish comments, while credit spreads compressed significantly. So all of these dynamics drove a very strong year-end rally across bond markets. But overall, despite this tumultuous year, you can see that bond markets generated positive returns with global high-yield bonds, which is the black line on the screen, returning up to 14% in the year to date. So this is something very equity-like return, and in fact, global high-yield bonds have outperformed several equity markets. So looking back at 2023, we believe that the fixed income universe is undergoing a transformation, like what my title suggests. So both interest rate as well as inflation have surged beyond what we are comfortable with over the past decade. As shown on this chart right here, you can see that increasingly both inflation as well as policy rates are looking like they are here to stay for higher for longer. But meanwhile, if you look around you, the behavior of global central banks have also changed. So over the past 6 to 9 months, policymakers have really warmed up to the idea of holding rates higher for even longer. So if you look at the meeting minutes or even in the news headlines, you can see that many central banks are still expressing that the war against inflation is not over. And they are also comfortable in holding rates at much higher levels, especially with the economy staying resilient. So all in all, we do think that there are major shifts in the macro landscape, and this will no doubt shape the returns of bonds moving forward. So despite this shift in the macro landscape, let me share over the next few slides why bonds remain vital for your portfolio, and more importantly, the opportunities that we see. So for us, there are two very important reasons why bonds remain important in your portfolio. So firstly, global bond yields have climbed drastically, and they are now near post-GFC highs. So this chart right here shows the yield of major bond markets as shown by the red diamond, and compare that to the historical average as well as the 90th percentile since the great financial crisis. So we use the 90th percentile here to represent how high yields have risen over the past decades. And you can clearly see that across bond markets, yields are not only trading above their historical average, but very much near their historical highs. So this is shown, visually this is shown as the red diamond being above the blue bar and close to the black diamond. So currently with yields at such high levels, forward returns of bonds have risen drastically. So for investors, what this means is that by investing in bonds right now, you can lock in a more attractive yield and also clip a higher coupon. So this greatly improves return, especially for longer term investors. And the second reason why we think bonds remain vital is that with yields at much higher level, there is now greater protection against potential decline in bond prices. So as we all know, bond prices move closely, or rather move inversely with yields. So a rise in yields will lead to a fall in bond prices. So with bond yields much higher, they can now absorb a larger rise in rates before investors lose money. So in short, right now, bonds not only offer higher forward return, but also a greater margin of safety against price downside, making them an important asset class in your portfolio. So let me share where we see opportunities first in 2024. So lately, with a fall in longer-term treasury yields, there have been talks on adding duration. While we see the case for longer duration bonds improving, we believe short duration bonds remain compelling. So let me share some of the reasons why. Firstly, yields of short duration bonds remain attractive, not only against history, but also against longer duration bonds. Short duration bond yields have really shot up after the steep rise in interest rate hikes across the world over the past 12 to 20 months. Interest rates have also hit levels not seen since the great financial crisis. And as you can see on the chart by the right, if you invest in global short duration corporate investment grade bonds, they might give you an average yield of between 1 to 2% over the past 10 years on average. But right now, they offer yield anywhere between mid-4s to 6%. So that is really an attractive yield level in the current day's environment. And on top of that, major treasury curves around the world are still inverted, Singapore included. So the chart on the left shows how the US treasury curve have changed over the past 2 years from being uninverted, which is the blue line right now, and to being deeply inverted, which is the black line above. So this also means that short duration treasuries are offering higher yields than their longer duration counterpart, making them more compelling in today's environment. So let me bring this back home. So right now, the one-year Singapore government security is offering a yield of roughly 3.75%. So this is significantly higher than the 10-year note, which yields roughly 2.7%. So this means that an investor can get almost 100 basis points of yield pickup for significantly less duration risk. So the second reason why we are sticking with short duration bonds is largely anchored by our macro view. So at the moment, markets are pricing in around 6 rate cuts this year. You can see this from the blue line on the chart where market expects Fed fund rates to end 2024 at roughly 3.76%. So it is important to also highlight that markets have been very aggressive. In fact, very, very aggressive in pricing in rate cuts over the past 3 months. You can see that from the expectation of Fed fund rates that have significantly fallen from the red line to the blue line. So we think that markets are too aggressive in pricing in rate cuts and will likely be proven wrong. So with the US economy proving more durable to higher rates, while inflation remains persistently sticky, we expect policymakers to push back against rate cuts. So at the same time, we do not think that the Fed rate cuts will come early, contrary to what markets are expecting. So what this means for investors is that interest rates will likely stay higher for longer, supporting short duration bond use for even longer. So absent major rate cuts, we see little upside potential for longer duration bonds for this year. So we look to turn positive on longer duration bonds when the treasury yield curve uninverts and re-steepens, as this gives investors like you and me a premium to hold longer duration bonds. So with short-term yields at around 4 to 5% right now, longer-term yields have to rise significantly higher than what they are offering now to even look attractive to us. So as we enter 2024, we think investors should also focus on higher quality bonds. And as a result of the steep rate hikes, cost of capital for many companies have risen significantly, exerting a lot of stress on investment grade as well as high-yield issuers. So with a higher for longer rates backdrop this year, we believe that investment grade issuers can remain resilient, while high-yield issuers will face greater financial pressure. So for high-yield issuers, the amount of maturing debt is expected to climb over the next 3 years, as shown on my chart here. And a maturity wall is expected to hit as soon as 2025. So this will potentially be a source for financial stress as well as risk for rating downgrades for several reasons. Firstly, high-yield issuers will need to repay principal on the maturing debt, which will be a hefty amount as compared to the coupons, the regular coupons paid. So this will likely occur in a backdrop of softer revenue growth, and therefore putting greater financial pressure on liquidity across many high-yield issuers. Secondly, many high-yield issuers will also be compelled to refinance at a higher cost, with interest rates staying higher for longer. So based on our estimates, issuers that refinance today are paying coupons of 3 to 3.5% higher. So for example, if you look at a US company issuing high-yield debt right now, they are paying coupons of around 9%. And this is compared to when, before the interest rate hikes, they are paying coupons of around 5 to 6%. So that is a steep increase and definitely substantially higher than what companies are comfortable with paying over the past decades of low interest rates. And unlike high-yield bonds, investment-grade bonds right now do not have a maturity wall ahead of them, as the amount of maturing debt will in fact decline from now moving forward. So this will ease some of the financial pressures on investment-grade issuers as well. So from a valuation standpoint, global high-yield bonds also remain unattractive as compared to global investment-grade bonds. So to show this visually, we can compare the credit spreads for the high-yield bond index to the investment-grade bond index as shown on the chart right here. So this tracks the credit spreads of high-yield bonds over investment-grade bonds relative to the historical level. So since the middle of last year, credit spreads of high-yield bonds have contracted much more than that of investment-grade bonds, even when compared to history. So this is reflected by the declining line and in the circled area, which is below the long-term average. So for investors, this means that high-yield bonds are relatively overvalued or more pricey as compared to investment-grade bonds right now. And additionally, we also look at the yield pickup of high-yield bonds over investment-grade bonds. And what we find is that in today's environment, if you invest in a high-yield bond index over an investment-grade bond index, you are getting paid an additional yield of 4.6%. So this may seem attractive by itself, but in fact, this is much lesser than what you are getting paid on an historical level, which is 5.1%. So considering higher for longer rates backdrop in 2024, as well as potentially higher credit risks from high-yield issuers, we think that a less than average yield pickup is not attractive, and investors are not getting paid, not getting sufficiently compensated for investing in the riskier high-yield bond index. So in sum, weaker fundamentals for high-yield issuers and less attractive valuations are the core reasons why we prefer to stick with higher quality investment-grade bonds. And for investors like you and me, we can express this in several ways. So from a bottom-up level, a tilt towards quality can be expressed together with our short duration preference. And we recommend IG bonds with relatively low remaining years to maturity. So the table here highlights our recommended Sing dollar investment-grade bonds with shorter tenors. So these are names with strong credit profile and offer attractive yields within the Sing dollar IG bond space. And from a top-down level, investors can maintain higher exposure to investment-grade bonds over high-yield bonds via IG bond funds. So I will share some of these recommendations in my final slides. So moving on to the next recommendation, Asian investment-grade bonds. We do think that this is a segment that looks incredibly attractive to us. So despite a more challenging global growth backdrop, we find that the fundamentals of Asian investment-grade companies or issuers have been very solid. So based on our observation, most issuers have remained profitable with positive earnings growth, while leverage ratios such as net gearing have also held steady. So this tells us that many of these Asian investment-grade issuers are still able to healthily meet debt obligations. And when we look at the changes in credit ratings for Asian investment-grade issuers, we also saw major improvement in the upgrade to downgrade ratios. And this points to a healthy credit profile. So in 2022, there was less than one rating upgrade per downgrade. However, if you look at last year in 2023, we have seen roughly 3 upgrades per per downgrade, which is back to pre-COVID level. So this is something positive that we see in the fundamentals of Asian IG issuers right now. But on a broader level, we also expect resilient growth from key parts of Asia, like South Korea, Singapore, Taiwan, and Indonesia. So this altogether, this country accounts for a sizable exposure within the Asia investment grade bond universe. And growth in many of these Asian regions are being supported by a revival in exports right now. So as shown by the Citi Economic Surprise Index, which is the chart on the right, you can find that the economic data for the APEC region has also been beating consensus estimates. So the greater the line rises above zero, the greater economic data exceeds expectation on aggregate. So this also tells us that the region is seeing better than expected growth momentum. But despite a solid corporate as well as macro fundamentals, we do think that credit spreads for Asian investment grade bonds remain slightly tight, trading at about 50 basis points below historical average. So for investors, this means that the potential upside from spread tightening may be limited, but this is not to say that we do not, this is a reason why we don't like this area, because we believe that the higher use from Asian IG bonds can serve as a compensation. So at the moment, Asian investment grade bonds are offering an attractive yield of around 5.2% on aggregate, which is near the post-Great Financial Crisis highs. And like I said earlier, higher yields can also provide a greater buffer for investors. So Asian IG bonds on aggregate can withstand up to 130 basis point rise in rates before investors sees a loss. So simply put, this is equivalent to 525 basis point rate hikes by the Feds, which is a big margin of safety in today's environment. So overall, with credit profiles for Asian investment-grade bonds largely stable, economic growth being resilient in the region, and yields being attractive, we remain positive on Asian investment-grade bonds. So since the global central banks started hiking rates furiously, treasury yields of major developed markets have risen to levels not seen since the past decades. So this has made risk-free, the boring treasury bonds viable investment vehicles again. So as the global rate hike cycle winds down, there are many who expect treasury bonds to fade in the background. But we do not share the same view. Instead, we continue to find several segments of government treasuries attractive and can enhance investors' portfolios' return. So for US and Singapore, we like the shorter-term treasury bills, which is in line with our preference for shorter duration bonds. And like I've highlighted earlier, the US and Singapore yield curve remains inverted, and yields of short-dated treasury remains much higher than longer-dated ones. And at the same time, yields from longer-dated treasuries are still very low and do not offer investors enough compensation considering the inflation and risk of hawkish policy surprises. So overall, we like the 6 months and 12 months Singapore T-bills and 1 year or less US T-bills, as this gives investors decent yield with minimal credit risk. So for example, a US T-bill today of less than 1 year can offer above 4.5% to 5% for almost no risk. And for investors who want to lock in yields for longer periods at a lower risk, we do think that treasuries above 1 year might not offer the best yields, and instead consider short duration investment grade corporate bonds. And like I've highlighted and shown earlier, investors can expect 4 to 5% yield with a 2 to 3 years to maturity, depending on the currency of the issuer, whether is it a Sing dollar or the USD issuers. So to wrap things up here is a slide which summarizes our view for bond markets this year, along with the rationale and the recommended products. So to recap, we think that bonds remain a vital asset class to your portfolios. Bonds now boast a higher forward return as compared to the past decade, and with higher yields, it offers greater margin of safety against price declines. So in short, investors like you and me can get a higher potential return for more downside protection. Thematically, we like the short duration bonds and higher quality investment grade bonds. Corporate credit-wise, we prefer Asia investment grade bonds, and for treasuries, we prefer short-term US and Singapore T-bills, which we see value in tenors 1 year or less. So before I conclude, I would just like to say that yes, the investment backdrop for bonds has changed, and we see 2022 as well as 2023 as a big reset for bonds as market digests the steep rate hikes as well as the sticky inflation data. Now that these dynamics are slowing and markets have digested these impacts, we believe bonds are reborn and they potentially can turn the tide on performance this year. So with that, I've come to the end of today's presentation. Thank you for your time and have a great year ahead.